I hope you all are doing well. It is a pleasure to have you on the call. I am Gandharv Tongia, CFO at Polycab India Limited. Thanks for joining us today to discuss our Q2FY21 earnings. During the call, we will be referring to the presentation, financial results, and financial statements, which are available on the stock exchanges as well as investor relations web page of our website. It can also be downloaded through the link or QR code on slide 10 of our earnings presentation. From our management team, we have with us our Chairman and Managing Director, Inder Bhai, as well as our Executive Director of Finance, Mr. Shyamlal Bajaj. Let me now hand it over to Inder Bhai for his comments.
Good afternoon, everyone. Welcome to call. I'm delighted with the Q2 performance given to the context of the current challenging business environment. Overall demand trends are encouraging and many of our customer-facing business have started seeing growth compared to last year. At the same time, we are tightening our belts to improve profitability without bargaining on long-term brand development and innovation in healthcare. While we remain optimistic of robust economic potential over mid to long term, government initiatives and reviving consumer sentiments should support demand in the months to come. We remain focused on augmenting our brand positioning in the electrical space and creating long-term shareholder value. I now request Gandharv to take you through our earnings presentation.
Thank you very much, Inder Bhai. Overall, Q2 has been quite good for us in many ways. I will try and highlight few of these during the presentation. On the domestic demand side, we are surely seeing signs of improvement with unlocking. Infrastructure and construction activities are back in action, and labor does not seem to be much of a concern now. Tier 1, Tier 2, and below towns saw healthy double-digit growth. Large metros are still facing impromptu restrictions in many states, which is dragging the overall momentum. However, on a sequential basis, we have seen considerable recovery here as well. In Q2, we also saw a surge in new infra investments. The requirement for wires and cables is generally back-ended in the construction cycle. Hence, materialization of these projects will bode well for the demand in near term. Investments from private side continue to remain soft. However, improvement in consumer sentiment and reviving demand in end-user industries will instill confidence on business outlook and boost investments. Macro indicators like IIP, manufacturing PMI, power consumption, etc. are also charting a broader recovery path, and hence overall we are quite optimistic and believe the worst is now behind. In fact, we have kicked off the new quarter on a positive note. As of now, we are witnessing healthy growth in all segments despite the fact we have a strong base of last year. Having said that, it is also worthy to note how many developed countries are witnessing a second wave of contagion and lockdowns. Hence, we will remain cautious and adopt a well-calibrated approach to ever-evolving dynamics of the market. Moving on to presentation with slide 4. For the quarter ended 30th September 2020, our consolidated revenue was down by 6% YOY as against minus 50% YOY seen in Q1. B2C categories posted a healthy double-digit growth, while B2B wires and cables are on a recovery path. EBITDA increased by 16% YOY, resulting with strong 272 basis YOY improvement in margin versus last year on the back of higher contribution and cost-saving initiatives. Our staff cost at rupees 897 million or 4.2% of sales, and our A&P spend at rupees 134 million or 0.6% of sales were broadly in line with last year. Our A&P side, we continued to participate in TV media during IPL season in line with our long-term brand development objectives. Our finance cost at rupees 114 million were lower by 10% YOY basis. Other income at rupees 327 million was higher due to exchange gains. A detailed breakup of our other income and finance costs have been provided on slide 14 of our earnings presentation. Our profit before tax at rupees 2.88 billion and profit after tax at rupees 2.21 billion, increased by 25% and 14% YOY respectively. Also, please note that Q2FY20 had a tax write-back of rupees 243 million for prior period due to reduction in the statutory tax rate. Adjusting for that, PAT would have grown by 31% YOY in Q2FY21, which reflects our overall improved profitability. Let me also take this opportunity to highlight our cost optimization program with BCG, which we have internally named as Project Udan. The Project Udan has been progressing well. While we are still in an early phase, we have started identifying and plucking low-hanging fruits. Success of this project will be one of our key strategic priorities in the near term. We are quite optimistic that it will help us build a lean cost structure which is sustainable and also institutionalize new ways of working. On slide 5, in the first half ended 30th September 2020, our revenue and EBITDA declined by 26% and 25% YOY respectively, largely reflecting the severe impact of COVID-19 on Q1. PAT grew 3% YOY, led by few one-off gains in Q1 as highlighted on slide 11. Moving on to segments, on slide 6, wires and cables, which is our largest business, saw decent recovery with improving economic activity, but closed at about 7% lower versus last year. On the domestic side, distribution channel performed better than institutional business, where we had to pass on some margin dilutive business. Geographically, North and East has been better for us in the last quarter. Robust momentum in exports continued despite weak economic sentiment, underpinning our effort to expand our global reach. We received approvals as well as orders from several large multinational energy and infrastructure companies in developed countries. We also made inroads into CIS countries during the quarter. On the whole, export revenue grew by 47% YOY and contributed almost 10.7% to overall top line in Q2 despite a stronger base. Sales to Dangote amounted to rupees 440 million for the quarter, and excluding that from current and base quarter, export was 5x of last year, led by a good traction seen in US, Australia, Asia, and Middle East. OFC business faced some sluggishness due to postponement of few projects. However, we are positive of good order flow in current quarter from domestic and abroad for OFC business. On the profitability side, segment EBIT margin grew 387 basis YOY, supported by better contribution. On slide 7, FMEG made a strong comeback with sales growth of 25% YOY growth in Q2. The segment contribution to overall sales increased 268 basis YOY to 11.4%. Growth was fairly resilient across most categories and regions. Fans grew strongly despite higher competitive intensity. Easing price environment in lighting business helped value growth as well as profitability. Pump sales more than doubled on YOY basis, held by channel expansion and product quality. Switchgear saw a revival, however, switches remained muted due to operational issues. While FMEG growth has been quite resilient, our teams have done a commendable job on the profitability side. FMEG segment EBIT margin rose from 3.3% in Q2 FY20 to 8% in the previous quarter, led by calibrated pricing action, premiumization, productivity improvement, and working capital intervention. While this level margin may not be sustainable in the subsequent quarter, as we expect a bulky charge of IPL-related advertisement costs for the year as a whole, we expect the margins to be better despite the Q1 hit. For the first 6 months of FY21, margin improved from 3.5% to 3.7%. Having made our mark in the FMEG space, we are now stepping up on the innovation pedal in a meaningful way. In about a month's time, we are launching a totally new portfolio of premium products which are IoT enabled with voice command capability. With a blend of functionality and design fused with technology, it will cater to evolving needs of new age consumers. This portfolio will cut across FMEG categories and function on a common Polycab IoT platform. We are very excited to roll this out into the market, and we believe this will be a pivotal movement in uplifting Polycab into an aspirational brand. We are also launching a host of electrical wiring accessories, including extension boards with USB ports, multi-plugs, holders, etc. These are entry-level products at every electrical counter and will help seed new consumers. In summary, we will continue to augment our brand and capabilities to outperform the market while progressing towards achieving industry-level profitability over the medium term. FMEG will be a key value driver for us over the long term. On slide 8, other segment, which is largely our strategic EPC business, witnessed a decline on account of a stronger base. The revenue was down by 65% YOY to rupees 580 million. EBIT stood at 92 million, down 60% on YOY basis. The copper segment, as disclosed in the financial results, largely reflects Ryker Base, which is a wholly owned subsidiary. As I alluded to earlier, we did not shy away from investing in brand building activities, even during such challenging times. Accordingly, we continue to be an associate on-air sponsor during India Premier League 2020 or IPL for the 4th consecutive year. We also conducted various on-ground promotional activities for several FMEG categories. For example, fans, where we launched 14 new products and over 40 new SKUs in past 6 months. Moving on to financials from slide 11 onwards. Our balance sheet grew stronger with nearly rupees 6.3 billion of net cash position as of September 2020 versus rupees 2 billion as of June 2020 and rupees 3.4 billion as of September 2019. ROCE as well as ROE in Q2 stood at 26.6% and 21% respectively. On the working capital side, while receivables have come down considerably, led by robust cash collection, inventory levels remained high, primarily due to purchase of raw materials in the last month in anticipation of improving demand environment and were in transit as of September end. Nevertheless, this is one of our key focus areas and we are aggressively working towards inventory optimization. Our inventory optimization program, which is named as Project Sankalp, is specifically targeting this issue. If I were to dive deeper into its progress, then on the finished goods side, we are in the last leg. Our fill rate and DOT rate have improved across SKUs and regions with optimal level of inventory. So it is looking in a good shape now. On the raw material side, we have identified the key enablers and are in the process of implementing it. My sense is that by end of this fiscal year, we should be on a better footing here. A key hurdle here is goods in transit. Since we procure a lot of copper cathodes from abroad, the RM is in the sea for nearly 30 to 40 days, which is difficult to trim. Even the current quarter's higher in. On the whole, we are confident of seeing improvement in this area in subsequent quarters. On the distribution side, our retail outlet reach as of September 2020 increased to over 137,000 outlets with over 3650 authorized dealers and distributors across geographies. Our key influencer connect program, that is Project Bandhan, now touches over 154,000 electricians and over 47,000 retailers. Lower tier towns, semi-urban areas, and rural holds great potential for a well-established brand like ours. While affordability and awareness are increasing, availability is a key challenge, and we aim to address this issue by developing an active distributor network in towns below 5 lakh population for all our B2C products. The pilot project I mentioned the last quarter is underway in 3 markets, and we are also seeking help of another reputed strategy consultant on effective implementation strategy. Talking further about strategy, I would also like to share another recent key development which is still in a very nascent stage, but is likely to be as a crucial strategic lever and an inflection point in Polycab's growth journey. While Project Udan, the cost optimization program, is the first leg of our transformation story, which primarily focuses on the cost structure and organization capabilities, we have commenced early diagnostic work on sales augmentation and roadmap for the medium term. Our vision is to become a premium global player in wires and cable space and one of the top players in domestic FMEG space over the next 5 to 10 years. For this, we will maximize our core by adopting next generation go-to-market strategies and add new muscles by expanding into emerging agencies as well as solution-oriented business models. Lastly, our culture, guided by simplicity, customer centricity, steady execution, and innovative effort, really resonates with our ability to deliver even during such challenging times. We will remain thoughtful in our decision making and actions to deliver sustainable and profitable growth for all stakeholders. With this, I hand over the call to operator and we can open the floor for question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Atul Tiwari from Citigroup. Please go ahead.
Yeah, thank you, sir. And first of all, congrats on continuing a strong performance in an otherwise tough environment. So this is quite heartening indeed. So I have three questions, if you can allow. The first is on the very strong margin that the company has been posting. So the question is, how much of this is sustainable? This quarter, obviously, your raw material costs are down as a percentage of sales sharply. So how much sustainability as far as margins are concerned should we factor in going ahead? And then I will ask a couple of more.
Thanks, Atul. Thanks a lot for your kind words, appreciating the performance. Atul, we have had this discussion several times in the last few quarters. The best way to analyze our performance is on annualized basis. Having said that, we have taken several steps in the last couple of quarters. If I talk about FMEG business to begin with, we have increased our focus on premiumization, whereby we are able to improve our contribution. And same is true for several other businesses within FMEG. To give an example, say fans, premium fans and all that. In the cable and wire business, the B2C business, which is a retail wire, is more profitable than a regular B2B cable business. And in the current quarter, B2C wire business has recorded a double-digit healthy growth, whereas the B2B cable and wire business has registered degrowth, and which is also helping us in improving our overall margin. But I will probably go back to the previous quarter when we discussed about the performance. I think for the purpose of your modeling, you can continue considering a range of 11 to 13% of EBITDA margin, which is sustainable. And if we follow that for your modeling purposes, probably you will not have any negative surprises. Having said that, I think the cost initiatives which we have taken in recent past, including what we are doing in Project Udaan, is slightly getting reflected in our profitability. And I am hopeful that in the coming quarters, Project Udaan and other cost-saving initiatives would get reflected in our P&L, both at contribution level as well as in the bottom line.
And this FMEG margin of 8%, which is obviously quite good on your small base still, is it repeatable, sustainable? Because it was up quite sharply.
Yeah, so as I mentioned in my opening remarks, in the third quarter, we were expecting a charge because of IPL, which will probably give us benefits in the subsequent quarters as well. But from the accounting point of view, we'll have to book that cost in the next quarter. But by and large, if you remember, till last quarter or till March of 20, we were generally talking about 100 to 150% EBIT growth every year. On the basis of whatever initiatives we have taken in last almost 100 days, I now feel that we would be easily achieve a number which is better than 100 and 150 bits. I think we should wait till end of this year to firm up this guidance, but at this stage I feel that to a great extent whatever we have recorded in this quarter would remain sustainable, barring couple of percentage points because of IPL spend and change in mix of sales, because one of the large business is fans, which is slightly seasonal in nature.
Okay, that is helpful. And then the second one is on your comment about growth in October. So you did mention, I think in passing, that in the month of October, across your business segments, you are seeing year-on-year growth. So any color on what kind of growth you're talking about? It's more like 5% or 10, 15% or 20%? Any rough indication? Low single digits, high single digits, low double digits?
Yeah. So a couple of things. One is probably 24 days in the quarter are not necessarily reflective of the performance. We will also have Diwali break coming in this particular quarter in the month of November, which could have a bearing. But as of now, if I just slice and dice the number on the basis of first 23-24 days revenue, the FMEG business is in healthy double-digit growth, followed by B2C wire, and after that it is B2B cable. Institutional business is still a challenge. There is a significant amount of progress if I talk about from a Q1 to Q2 perspective. If you remember Q1, our institutional business degrew almost by 70 to 80%, whereas in Q2 it has degrown at max by around 30 to 40%. So that business is still a bit of a challenge, which is only a part business of cable and wire. Predominantly we are a distribution company. But overall, the B2C business is registering a good growth in double digits, followed by B2B business, and institutional business, I think, is still in red.
Okay, and sir, my last one is on the Dangote order. How much of it is left to be executed?
I think we have to do almost 150 crore rupees rounded off between October and say by December. In last 25 days, we would have supplied almost 40 crore rupees in the month of October. So we need to do around 100 crore rupees or thereabout. But the good thing is, Atul, Dangote has given us a follow-up order of almost $10 million. And this is in addition to what we were talking about in the last quarter, that we are focusing now on distribution-led export growth. So whatever growth we have registered in this current quarter, if I exclude Dangote, both from the current quarter as well as from the base quarter, export has increased almost by 5 times. And if you remember, I was talking about in the last quarter that we would like to have at least 10% of revenue coming from exports, which we have achieved in this quarter itself. So we would like to make it sustainable. And the follow-up order we have received is required to be supplied in next couple of quarters.
Oh, so this 10 billion rupees of follow-up orders will also be supplied fully by March 21?
Yeah, it's USD 10 million.
Sir, USD 10 million. Oh, sorry. I thought
it's a follow-up order.
Okay. Thank you, sir.
Thank you, Atul.
Thank you. The next question is from the line of Aditya Bagul from Axis Capital. Please go ahead. Mr. Aditya Bagul, please go ahead with your question. Your line is in talk mode.
Hi, I hope I'm audible.
Yes.
So first of all, Gandharv and the entire team at Polycab, heartiest congratulations. Really good set of numbers amidst really challenging times. So my questions, I have 3 questions. I think all of them are on the FMEG segment. The first question that I wanted to understand from you is whenever we've reached a sizable base of 800 to 1,000 crores annually in terms of FMEG. So with this base and the growth in margins that you're confident about, can you help us understand and split the margin performance into how much comes essentially because of premiumization, how much would come through cost control initiatives, some color on how the EBIT margins would improve and what is the color on that? That is question number 1. Question number 2 is again on FMEG. If I understand correctly, I think 18 to 20% of distributors are common between FMEG and cables and wires. So wanted to understand whether that number is likely to improve meaningfully or how do we think about that sort of a matrix? And the third question is far more long term. One of our peer has sort of multiple sub-brands within its own umbrella. That makes it a very, very competitive player, especially within the FMEG segment. With Levana in, do we have some thoughts on sort of expanding our product baskets into multiple brands as well? So those are the three questions.
Thank you. Thanks a lot. Thank you for your kind words. Let me go in the same order. FMEG, you are aware that we started this journey almost 5 years back, and the focus was to establish a business, and we launched almost all the products in a period of 12 to 18 months. Today, probably we are the fastest growing FMEG brand in the country with a positive EBIT and acceptable level of working capital. I had mentioned it in the last quarter call that within FMEG, now we are trying to review our performances into broad two categories. One, where the businesses are slightly large in comparison to others, for example, fans, light and lume, and switchgear, where the focus is on both improving the top line as well as the profitability. And the other smaller businesses, though profitability remains a priority, the most important thing there is to increase the top line. For example, agriculture pump, which is a small business, but has registered almost 100% growth in this particular quarter. So the focus there is to ensure that the existing businesses, we continue to improve our profitability, and which is getting reflected in our second quarter performance. I mentioned about a few new products which we are going to launch in around a month or so, which would be next generation products, IoT based, and those products would be probably placed around premium category, and that would help us in improving our profitability as well as establish Polycab as an aspirational brand. Within the existing businesses, for example, fan, though we have entry-level products or slightly products which can be fitted into typical economic category, like from a Zoomer or all that, we are making a specific focused effort to improve penetration of premium fans, and that is true also for the other product categories. So both in the existing businesses, we want to increase the premium component wherever it is possible and improve the profitability of the core FMEG business as well by taking pricing actions. The second part is introduction of new products, new generation products, IoT and all that. So all these put together would help us in improving the FMEG margin. As a response to the previous question, I mentioned that generally we used to give guidance of around 100 to 150 bps improvement in EBIT margin every year. On the basis of whatever work we have done in last 90 to 100 days, I have reasons to believe that we would be easily be able to beat that guidance. But I think it will be appropriate for us to wait till year end before we revise that guidance. But I am now more hopeful than what I was in last quarter in terms of improving margins of FMEG. The last thing before I jump to the next question is on the working capital. In the current quarter, we have taken several steps to increase and to augment the working capital levels of FMEG business. To give you an example, the inventory levels we have been able to reduce significantly. The channel financing percentage in receivable has improved, and it is now in high teens, which used to be in low teens. And this activity will continue on a sustainable basis in the coming quarters as well. And this will also be reflected in the performance of FMEG P&L in the quarters to come. You mentioned about the dealers and distributors, and you are right that there are common dealers and distributors, but I think I'm more excited about the recent initiative which we have taken, wherein we want to work on identified key states and ensure that we are available in all the key markets within those three identified states and provide all the Polycab products, whether it's FMEG or wire. And I think between now and the year end, we would have the results of this pilot which we are working on, and depending on the learnings from this pilot, we will probably replicate it across the country, and that will probably take us to each and every corner of the country. However, having said that, it is a long-term project. I don't expect that we would be able to cover the entire country in a few quarters, but directionally we believe that is the only way to ensure that we are available across the country. The third thing is very important one, Aditya, about brand. This is a question which internally also we are grappling with. I think we have reached to a stage where we can finalize our position, what we need to do as far as brand is concerned. But I'll probably defer it to the next quarter of the year end and come back to you in terms of final thought process on that. And I'm sure between now and the year end, we would be able to update you on that.
Perfect, Gandharv. I think that answers all my questions, and best of luck for the quarters to come.
Thank you very much, Aditya.
Thank you. The next question is from the line of Chintan Sheth from Samiksha Capital. Please go ahead.
Thanks, Gandharv, and congrats for a very good set of numbers to the entire team as well. Gandharv, on other expenses, if you can pull out any large item which has resulted in a strong saving this quarter, because if I look at the numbers sequentially, other expenses are down significantly.
Thanks, Chintan. Thank you for your appreciation and kind words. The other expenses have slightly changed. If I could call out one or two items, one is the exchange difference, which was sitting in the base quarter as a loss, which is not there in this quarter. The second one is because of Ryker acquisition. Till last quarter, the Ryker cost used to sit in subcontracting expenses, but since now it's a wholly owned subsidiary, it is getting reflected in a natural line item, for example, power and fuel, and that is also giving us some sort of benefit. So overall, if you see, our power and fuel has slightly optimized. But other than that, I don't expect there are any major items which can be highlighted to you at this stage. If you wish, you may go through the entire set of financial statements, which has a complete listing of other expenses as hosted on our website, and happy to give you inputs if you want to understand any particular line item in the other expenses.
Sure, thanks. And on the exports, you mentioned $10 million of Dangote order. So we must have received advance this quarter, or it will come in third quarter?
No, this is a recent development. So there is no advance which is getting reflected as of 30th of September 2020 as against this particular order.
But we will receive some advance from that, right? If I see, like in the earlier contract, we received like some 40% of the project was early on before the supply started.
Yeah, so it's a combination of both, but Dangote is an existing customer now, and that is where we have additional level of comfort. But you are right, it would have combination of both advance as well as security against LC.
Right, and any number you want to point out on the IPL cost, which will likely to accrue in the coming quarter? The run rate, if you can just, how the percentage of sales will look like, if not the absolute number.
I think we have incurred almost 1/5 of IPL spent in the September quarter, and 4/5, or which is 80%, would be accrued in the next quarter.
Sure. Thanks, Gandharv. That's all from me. Thank you.
You are welcome.
Thank you. The next question is from the line of Garima Mishra from Kotak Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats on a good set of numbers. Two questions from me. First, have you thought about expanding your presence more across e-commerce, and what proportion of your sales currently go through that channel?
Thanks, Garima, for your kind words. You already know that 80% of our business comes from distribution. 75% of the 80% comes from dealer portal, wherein our dealers key in their orders, and then those supplies are made without any significant human intervention. So on the distribution side, we have already implemented it, and this 75% will only improve in the subsequent quarters. On the B2C side, we don't have such a facility as of today, but probably in few months from now, we would have a facility, a typical e-commerce facility to provide our B2C products.
Okay, understood. And second, my question is also on demand. Do you think this quarter, the second quarter, you had any element of pent-up demand because a lot of products were not available in the first quarter and customers may have, put off some purchases? And a related question to that, how sustainable do you think these current demand trends are? Because if you see from a very top-down perspective, we are talking of negative GDP and, incomes getting lost. So how does that tie in with the very strong demand trends that you are seeing across your product categories?
Yeah, I think that's an interesting one, Garima. Thanks for asking. I don't think there is any significant element of pent-up demand in Q2. There was some to the extent of Q1 in the month of June, or slightly, partially in July, but not considerable amount in the second quarter. When we talk about GDP degrowth, I think the maximum component of degrowth is coming from this first quarter, which is behind us. And I don't expect that by and large companies are going to witness the same amount of degrowth which was there in the first quarter in the coming quarters. It could vary from industry to industry and company to company, but I would be really surprised if any company goes back and declares performance which is more or less in line with what they experienced in the first quarter. And that is why we believe that the second half should be better than the first half. But as I called out in my opening remarks, there are some challenges which are outside the influence of the company due to COVID environment, and that is where I think we should remain slightly cautious. But overall, I think the second half is going to be better than first half.
Got it. Thank you, Gandharv.
Thank you, Garima.
Thank you. The next question is from the line of Manoj Joshi, individual investor. Please go ahead. Mr. Manoj Joshi, please go ahead with your question. Your line is in talk mode. As there is no response from the current participant, I have muted the line. We'll take the next question from the line of Devansh G from SIMPL. Please go ahead.
Yeah, thanks for the opportunity and congratulations on a very good set of numbers. Sir, my question was predominantly relating to the benefits which have come from the Ryker acquisition. So correct me if my numbers are right. I think we are seeing 3.5% saving in contract expense per quarter, and I think that translates to 50-60 crores. And I think we did a 200 crore acquisition for Ryker. So if you could just re-clarify on those numbers again.
Sure. Thanks a lot for asking. Let me just give you a background about Ryker before I specifically deal with your particular question on savings. Ryker is a result of our thought process of having backward integration in place. For us, copper is the most important raw material, and Ryker converts a form of copper into another form. Technically, it is called copper cathode, which are generally procured by us from countries like Japan, and Ryker then converts that form of copper, which is cathode, into rods, and then these rods are used for the manufacturing of cable and wire. What you are comparing is not necessarily the correct way of comparing, because till last year, this particular entity was a joint venture, and as per the accounting standard, any expenses paid to a joint venture used to be disclosed as subcontracting expenses depending on the nature of the item. Whereas now it's a wholly owned subsidiary from May of this year, and because of consolidation principles, the amount any paid to by Polycab to Ryker is required to be knocked off. But overall, there is a savings on account of two reasons. One is we get economies of scale advantage, and second is the overall quality of copper is under our supervision, right from procurement to consumption, and that is where we get operational advantage. Riker is going to help us in overall improving the profitability, but I don't think the magnitude would be to the extent of what you have mentioned a while back.
Okay. And another question was relating to exports. So probably we used to do around 50 to 100 crores run rate, and I think it's around 190 to 200 crores this quarter. So if you can just throw some more light on the soft points on the the way we are trying to build up this export business, and since we are a challenger in this export distribution-led business that we are trying to create, so if you can just throw some more light on that.
Yeah. So in the current quarter, we did almost 225 crore rupees of exports as against the base quarter where we did almost 153 crore rupees. But this export journey actually started almost 2.5 or 3 years back when the chairman and managing director and other team members decided to ensure that we have all the required approvals in place. In India, you would have seen or heard terms like ISI approval. Similarly, in developed countries, there are approvals required. To give you an example, UL approval in the case of US, and that we started almost 2.5, 3 years back, and now we have almost all the approvals in place. There are few which we are still working on, but that is the first step which we took almost 2.5 years back, and that is getting reflected in the export top line now. The second thing which we have done in almost last around 500 days or so is, in addition to the Dangote sale order which we secured, we have started penetrating the markets in the identified geographies, for example Australia and US. Now we have wholly owned subsidiaries in the US as well as in the Australia, and the objective is twofold. One is to have a local distribution presence in these developed economies, and this is what precisely we did even in India. Till 2010-2012, we were a typical B2B business, and slowly and gradually we started moving away from B2B to a distribution-led business, and today we are only a distribution play. The same thing is what we want to replicate in the export arena as well. The second thing when we are talking about export, in addition to distribution, is there are identified sectors where we want to ensure that we are present. To give you an example, say oil and gas. So we want to ensure that in the identified sectors, the few select major players within those sectors should be our clients, and that is where we are making effort. It's a long way to go, but on the basis of whatever work we have done in the last 2.5 years and the numbers which we have been able to report as export revenue in the recent quarters, I think we have done a decent work there, and the direction and pace is in line with what we initially contemplated.
Okay. Also, just a bookkeeping question. So this is regarding the travel and conveyance, which obviously now will be at a very low level. When do you expect this number to normalize? Because almost there is a 5-6 crore delta this quarter, and which is one. And also in rental cost, I mean, I think it's normally around 5-6 crores. So over there we have booked around 1.5 crores. So we have 3-4 crores delta over there as well. So if you can just re-clarify on these two numbers.
So I think a couple of things. COVID has changed the way the entire world is functioning, and we are no exception. The good thing is, since last around couple of years, we started making investment in technology. The entire sales force is now on Salesforce automation tool, and now they are not required to come to their physical offices. From their respective homes, they can directly go to the market, and we get reports with the help of technology which we have implemented in things like their beat pass, the number of retailers attended by them, and so on and so forth. So, we are leveraging on technology, and that is where we feel that the traveling cost not necessarily would be a significant cost. But, the export business may require some sort of travel, and that is where it could result into almost like a comp or an adjustment. But directionally, the use of technology will increase, and as a matter of fact, has already increased in the last couple of quarters. That's on this. On the rental one, I think one thing which I'm sure you would have already know, there is a new accounting standard by the name of Ind AS 116, and the rent expenses in general are routed through depreciation line item, unless a particular line item or particular lease cannot be covered under 116, and that is what is getting reflected in rent. But overall rent expense is not significant in our case, and it is quite possible that rent expense on the offices would reduce in the coming quarters. I hope I have answered your question.
Yeah. So that was quite elaborate. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that management is able to address questions from all participants in the conference, please limit your questions to one per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The next question is from the line of Mayank Bhandari from B&K Securities. Please go ahead.
Yeah, thanks for the opportunity. Sir, I have a question particular to your subcontracting expense only. In FY22, we had about 189 crore of subcontracting expense in the other expense, which was about 66 crore in FY18. Sir, overall, what does it comprises of? Is it related to only your EPC business, or it also has components from the cycle plant? Can you just break it down in terms of?
So this is the cost which is paid to our contract employees, and whatever work we get it done by third-party vendors as job work.
It has gone down significantly in this quarter. Any guidance for FY21?
This has gone down because the last year such costs used to be reflected in the P&L because it was a payment to Riker, which used to be a JV entity. Now, since it's a wholly owned subsidiary, it is required to be eliminated and is not required to be reflected. As a contra to that, whatever expenses are being incurred by Riker, say for example, stores consumption, power and fuel and all that, those have been added on line by line addition basis in accordance with the consolidation accounting principles as per Ind AS.
Sir, we have seen that we have done pretty good in terms of receivables. In last 2-3 years, the receivable days have improved, and we are continuously focusing on channel financing in FMEG also. Sir, any next 3 years, would you give any guidance for receivable, like after the channel financing has increased in FMEG up to a level of let's say wires and cables, what you have? What would it look like overall receivables days? Any guidance you have?
Yeah, Mike, we as a company, generally we don't give guidance, but I can certainly add a few thoughts here. In the case of cable and wire, the channel financing percentage or penetration is almost 60-65%, whereas in the case of FMEG business, it is in high teens. And that is where we have significant amount of improvement scope. In the coming quarters, our expectation as well effort would be to increase the channel financing percentage within FMEG business. I don't think it is quite possible to get to 100% channel financing. It's impossible. But even if we are able to achieve a channel financing percentage, what is there in cable and wire in the FMEG business, this will significantly reduce the receivables because the contribution of B2C business is slowly and gradually increasing. If I talk about FMEG business, it's almost 10% of our top line. And if I talk about B2C business, it's almost 40% of our top line. So in the years and quarters to come, I would expect this number to further improve.
Thank you. Mr. Bhandari, may we request that you return to the question queue for follow-up questions, as there are many participants waiting for their turn. Thank you. The next question is from the line of Manish Agarwal from Edelweiss. Please go ahead.
Hi, sir. Congratulations on a great set of numbers. Sir, firstly on the FMEG part, we are seeing great advertisements, very catchy advertisements actually during this IPL season on our, lighting part and cables and wires as well. So, on FMEG, just a big picture question, are you seeing some traction? I know it's very short term to answer, but is it leading to some traction? Is there some way we do measure, the consumer demand or the consumer pull that comes along? And the second question, sir, on the cable and wire segment, sir. So what is your view on the extra high voltage segment? I mean, how big are we there, or is it a big niche market? Some color on that part, sir. That's all. Thank you.
Thanks, Manish. Thanks for noticing our advertisement, and thank you for your kind words appreciating our advertisement. I think if I'm not wrong, what you're trying to understand is whether the advertisement will result into any short-term benefits in the top line. And if that's correct, answer is yes. The time frame is unknown, but we as a company, we believe that we have to make and continue to make investment in strengthening our brand. We have achieved a fair amount of success in last 5 years. If I'm not wrong, 6-7 years back, we used to spend only 10 crore rupees as advertisement, or probably 5 crore rupees. Last year, we would have invested almost 100 crore rupees. So that is where we are cautious that for a B2C oriented business, we have no option but to invest in A&P, and we will continue to do that. And this will only increase in terms of absolute amount in the coming years because the B2C revenue will increase. And that is where it's going to help us in overall augmenting the top line of the B2C business. This also has a rub-off effect on the B2B business. So overall, it's going to be a positive for the top line growth of the organization. The second thing I think you were trying to understand our overall plan of action on extra high voltage. EHV typically is done in EPC arrangement, and for EPC, the company should have PQs or pre-qualification in place. As of now, we don't have any such pre-qualification or PQs for EHV business. However, since last few years, we have been working on EPC business, and we have obtained few pre-qualifications, not in EHV, but over the period, we have strengthened our PQ qualifications in EPC. But we would be able to venture into EHV only when we have EHV pre-qualification, which presently we don't enjoy.
Thank you. Mr. Agarwal, may we request that you return to the question queue for follow-up questions. We'll take the next question from the line of Ankur from HDFC Life Insurance. Please go ahead.
Yeah, hi sir. Good evening, and congratulations on the good set of numbers. I had two questions. One, if you could talk about the overall industry, obviously the degrowth you've seen on the cable side and the domestic business, and the kind of growth the industry would have seen on the wire. I'm assuming just like you saw this good growth on the wire business, the industry would also have. So that's one. If you could comment on that.
Yeah. Thanks, Ankur. Good evening. The overall industry, let's split the industry into two parts. One is organized and second is unorganized. In the first quarter, whatever we were able to gather, we believe that there was a significant amount of degrowth in unorganized sector. But in the second quarter, there are some signs of revival in unorganized because few of them have been able to manage their capital issues, working capital issues, and availability of labor issues. So there, I think there's a bit of a rebound within the unorganized sector. But overall, the unorganized sector has decreased over the period, including between last year and this year. On the organized sector, I don't think we should take a view on 6 months basis because overall the private capex spend has not increased in the first 6 months. First quarter was not necessarily was very impressive. Directionally, the private capex has improved in second quarter on a sequential basis, but I think we should wait till end of this year before we take a view on the organized wire and cable market.
Fair. So overall, I was asking about the overall industry degrowth in cables, if you have a number in Q2, and similarly, any numbers you can share on the overall industry growth on the wire side? Would you have some numbers?
We'll have to wait for the results of the other large players before we take a view on the overall industry level. But it seems that large players would have increased their overall top line in the B2C wire category.
Okay. Got that. All right. Great. Thank you so much. That's all.
Thank you, Atul.
Thank you. The next question is from the line of Bhumika Nair from IDFC Securities. Please go ahead.
Yeah, good evening, sir, and congratulations on a good set of numbers. So just, wanted to understand a little more on the B2B cable segment. As you mentioned that, October has seen a growth across all categories. Now, would it be fair to say that there, from March onwards, given that there has been, almost a stalled, work in terms of institutional projects, that will kind of start picking up, and for the next 6-9 months, there should logically be a strong growth for B2B cables, or is that something which will become actually more back-ended and will still remain sluggish for the next 1 or 2 quarters? And second is on the FMEG margin profile that we saw at a very strong level of 8%. If I remember correctly, we were talking about 100 to 200 basis point margin improvement on an annual basis on an each year. So does this change that guidance or that kind of an outlook in any manner?
Yeah. Thanks, Bhumika. So, Bhumika, when we are trying to study the pattern in B2B, we'll have to understand the overall capex, both at government level as well as private capex. The private capex has certainly improved between first quarter and second quarter, but I think it can further be improved. And government has increased spend, which is visible, but it can again be further improved. But I think the worst is behind us. I don't think there is any two-view about that. It will only improve from here. It could take a quarter or two to overall get to the the position where all of us would like to. But significantly, I feel that overall H2 should be comparatively better than H1 on B2B. As far as B2C is concerned, I think that is already visible, whatever we have witnessed in second quarter as well as whatever witnessed in the first 20-25 days October month. So I think B2C is given, but the B2B I think directionally should improve, but we should just be cautious and monitor it at a regular interval. On FMEG profile, Bhumika.
Sorry, sir, just one thing in month of October, like you said, 2Q saw about a 20-30% decline for us in terms of B2B cables. That trend would have continued in terms of a decline into October as well, or is there an improvement?
I think in the case of B2B business, we should not take a view on the basis of 20-25 days, because in our experience we have seen at times the supplies are done in the second fortnight into B2B business, and that is where a 25 days sales is not necessarily be reflected. So I think we should park it for a quarter and take a view on that. But directionally, what I was trying to allude to is it looks like that B2B is now bouncing back, and in the coming quarter, we should be able to get a comparatively better number what we have seen in H1. Coming to FMEG profile, Bhumika, I don't know whether you were able to capture my earlier comment. What I was trying to highlight is we have taken several initiatives. One is increase in the top line as well as profitability of the larger businesses within FMEG. Second is the smaller businesses where we want to increase the top line while maintaining their profitability. Third is we want to launch new products which are next generation IoT enabler products. And the fourth is the focus on the working capital, where we have already reduced the inventories to a fair extent, but we can further improve there, as well as increase the channel financing percentage. So all these things put together, we feel we would be able to improve the overall FMEG profitability. I know that we used to give a guidance of 100 to 150 bips improvement every year, but it seems on the basis of whatever work we have done in last 90-100 days that can be further revised upwards or on the higher side. But probably we'll wait for a quarter or two before we finally call out on the revised guidance. But I'm pretty confident on whatever work we have done so far, and hopeful that the FMEG profitability will continue to improve from here onward. The only thing which I would like to call out at this stage is the spend on IPL, which will be accounted for in the third quarter, because the accounting standard requires us to account for it now, which from a business standpoint probably would agree is more like an investment. So that could slightly impact the profitability in third quarter, but overall, directionally, profitability of FMEG should improve from here onwards.
Got it, sir. All the best. Thank you very much.
Thank you. The next question is from the line of Prashant Kutty from Sundaram Mutual Fund. Please go ahead.
Yeah, hi. Thank you for the opportunity, sir. Pardon me if the questions were asked before I joined the call late. Just one bit. Firstly, we remember correct me if I'm wrong, when you had highlighted around the last quarter, and also in a couple of conferences, that we were tracking at a positive sales growth around August or so, July, August or so. We ended the quarter with a negative growth rate in the full quarter. Anything that is deviated from that in the last 1.5 months or so? Share your thoughts on that.
Yeah, so probably, Prashant, we'll have to go to the context in which we were having discussion. But on an average, if I see, within the quarter on different periods, a month, 2 or 3, generally the B2C business has registered growth. The B2B business, predominantly because of institutional sluggishness, there is a bit of a degrowth which is witnessed. So I'm not able to recollect what was the context when we had the last discussion, but broadly, the trend as of the end of the quarter is in line with what we generally experience throughout this quarter.
And just a clarification, you said that October is now almost seeing a recovery in almost all businesses. A positive traction in almost all businesses. Is that a fair?
Yeah. That's true. The only thing is, and this is what again I would like to call out, which I mentioned a while back, 20-25 days is not necessarily reflective of the month or quarter performance. And second is institutional is still a challenge.
True. I'm sure. Second question is on the margin part. Just